So to update our reports, really, that Russia and China had begun weaponizing the very large physical gold reserves that they own. And these reports we've been receiving since then on how this trade is expanding is now spilling out intermittently through global news reports, illustrating that the other friendly jurisdictions, including the BRICS Plus countries, are increasingly adopting the Russian gold-backed stablecoin announced by Russia's Sberbank on the 2nd of January. Now, the increasing adoption of a gold benchmark to price all commodities is what is driving a physical gold price higher, offsetting any bouts of returning dollar index strength. Now, that is a change in behavior. Now, aside from this game changer, are mainstream media reports on the potential wider integration of emerging market currencies. They're seeking to iron out the inherent high volatility against the dollar, while creating baskets of fiat currencies. They're discussing that, but that's pegged to a dollar, and it's really just a diversion and inherently flawed, as they do not provide the ability to fully opt out of an increasingly weaponized dollar. However, adopting gold as a benchmark to create a basket of gold-backed currencies would enable a diversification of these reserve holdings, allowing these jurisdictions to gradually opt out of the increasingly weaponized SWIFT payment system. Now, while we're seeing several concurrent efforts to form a basket of fiat-based BRICS currencies, they're doomed to fail. I mean, they're going to fall by the wayside as as this common gold-backed currency becomes the only sustainable alternative benchmark price for commodity trades between nations. Now, originally, the BRICS Plus move to de-dollarize was estimated to take at least 5 years to gain sufficient traction to impact the dollar trade. People were saying, it may happen, it may not happen, it's going to be 5 years down the road. But following Russia tokenizing physical gold at the open of New Year's trading, liquidity providers report the adoption of gold to price the multi-billion-dollar energy and commodity sector. This time, it's going to significantly, it's going to really create this huge change in pricing. Now, potential liquidity to drive adoption of tokenized gold. So if anyone's doubting, there's not enough liquidity. No, the global oil and gas markets alone are worth $7,500 billion. Then add in the 5,000 billion commodity and energy sectors, and the scale of gold adoption becomes clearer. Don't think people have thought this through yet. We're currently in meetings with our well-connected first-tier liquidity providers to better assess how this will translate into a real physical supply-demand price and on what timescale. But what is clear is that the inherent Western cartel paper gold derivative game is going to implode, and we're gearing up for it. And we discussed in our last episode what is patently clear is that the so-called LBMA professional trade got truly blindsided on the first trading day of 2023, triggered by the surprise move from Russian Sberbank reporting it had been licensed by the Russian central bank to tokenize physical gold on their proprietary Stellar blockchain. Now, the objective is to benchmark a physical gold gram price for a wide range of physical commodities. And as I say, the potential scale of this, I've just outlined the potential scale of this, but what has just been sprung on the LBMA CME ring fence is just the thin end of a very large game-changing wedge into which a real physically settled price, much higher price for immediately deliverable gold will emerge. They're not talking about deferring it in derivatives. This is physical gold backing every single gram. And it will increasingly be determined by real physical supply demand fundamentals, which we've just outlined the potential of. Now, while blinkered Western analysts Oh, they're desperately trying to interpret the gold rally from last November's lows. Oh, they were attributable to the Fed turning less hawkish. Well, of course, it was helpful in so much as the led-by-the-nose CTAs, if you remember the CTAs, just the professional traders, we call them the specs, basically. And they started short covering and going long paper gold. But historically, these CTAs were also being set up by the cartel for a New Year rinse of these non-deliverable futures positions. And this was quite evident by the rising casino-centric bets against these paper long positions. So that's the one good thing you may see the COT report for, although it does not show the other side of the picture. However, the New Year gold weaponization move by Russia completely wrong-footed these large derivative short bets that were being set up by the cartel, catching the cartel offside basically, forcing them to scramble to short cover. Now, the rapidly changing option structure, this is the derivative structure, provides a really solid clue that very large hidden bilaterally settled derivative bets that are attributable to these option structures are severely offside for the cartel. Now, recall how persistent LBMA cartel short seller was Toronto Dominion Bank admitted it had misjudged these bets, which were betting on lower gold prices into the end of the year. And they were caught offside on these at-the-margin leverage trades, which relies on the fact that COMEX-centric CTAs never take physical delivery, so they can be led by the nose to act in unison. However, the fresh uptake of physical gold at the margin forced house short covering. There's leverage there. They were wrong-footed by, as they put it, well, they were saying, oh, who in the world is the mystery buyer driving prices higher? This is, of course, before they realized that this was Russian and Chinese central banks, but it was the gold commoditization move that really neutralized their plan to rig gold prices lower, which they were set up to do. Now, given the scale of the strong rebound in the dollar index at the open of the year, and as we opened the year trading, the dollar rose, gold simultaneously rose through the top of the chart painted ranges, rising alongside the dollar index. This long-standing inverse dollar to gold trade tool imploded. In other words, whenever the dollar was going up, the HFTs would come in and sell gold, tick for tick. Now, if you recall, we, along with some of our live from the Vault guests, like Dave Kranzler, were anticipating a strong rally setup similar to 2008, which was the last time we saw safe haven gold rising alongside so-called safe haven dollars. Now, despite every effort by the cartel to try and call a top and to incentivize the led-by-the-nose CTAs to assist in swamping these physical-driven upside moves with paper gold, leveraged paper gold, gold held up extremely well, with every single dip being jumped on into the usual gamed Fed gaming events. Why is the question? Because Basel III compliant gold was being drained out of the LBMA CME swamp at every fix. Now, this unfactored physical gold demand has continued and has sent a wave through the industry as other international banks and jurisdictions now begin to embrace this physical de-dollarizing solution. The lion's share of raw commodities are in control of Russia and the BRICS alliances, sufficient to dictate the price of these commodities in physical gold grams.